to Tom Williams, the question came up about, as you said a moment ago, Gavin, how do you know if the market is going to come back and give you a test or not? The answer is you don't know. Nobody knows. I think immediately of the book by Mark Douglas. I don't know how many of you have read it. It's called Trading in the Zone. It's one of my favorite books. I don't read many books about markets or certainly about market psychology, but I think this is a very good book. And he says in there a couple of things. First of all, we work in a probabilistic environment. Number two, anything can happen. I mean, look the other day on the 6th of May, what happened? Who could possibly foreseen such a thing to occur? I knew the market was poised to go down at that time, but I never in my wildest imagination would have expected to see the Dow down 1,000 points. And in addition to that, we have the problem that not only do we not know what's going to happen, what's the other one? The other part of the equation? Nobody knows. Nobody. You can go ask the 12 disciples. They're not going to tell you what's going to happen. Nobody knows. Anything can happen. If you can get comfortable with living and working in that kind of an environment, you're made for trading. If you can't get used to that, it's going to be much more difficult. But that's the reality of what we deal with. That's why yesterday when we were talking about springs, and I was asked, do you wait for the secondary test? And I said no, because I don't know if there's going to be a secondary test. What's the percentage of time that you have a secondary test? Will that help me any? Probably not. So I just buy the spring. That's all. Now, talking about not knowing, the first chart here is entitled Bar by Bar Evaluation. Those of you who saw my DVD from Dominican Republic a few years ago, I had this little exercise on that DVD. In other words, you have two bars in problem A. Let me be sure. Yeah, problem number 1. There are two bars, bar A and bar B. Looking at those two bars, what can you infer will happen on day C, which is not shown? Just looking at those two bars, that's your whole chart. Any ideas of what's going to happen? I see someone pointing down. Yes. He's pointing up. Anyone else want to venture an opinion? Well, I appreciate the two opinions. Anyway, nobody knows what's going to happen tomorrow. I don't know what's going to happen tomorrow, but I'll tell you how I read this. That's all I can do, is tell you how I read it. And I'm not necessarily right, I know that. But when I look at this problem, the first day, day A, notice that the stock or commodity or whatever closed in the middle of the range. All of these are in downtrends, by the way. I do that because I prefer downtrends to uptrends. But anyway, we close in the middle, so that tells us right off what? There was somebody buying, yes. Then on bar number 2, what happens on bar 2 that tells us what's going to happen the next day? Number 1, the range is a little narrower. Number 2, the close is well off the low. Number 3, the close is above the low of the previous day. All of these things suggest to me that the market has a better chance of going higher, or at least beginning higher, on the next day or the next bar. You understand how I'm thinking? I'm looking at the size of the range, the position of the close. If the close is above or below the previous day's high or low or close, all of these factors come into reading the bars on a daily basis or a 5-minute basis, but particularly on a daily basis. Look at number 2. On number 2, we have a wide spread or range on the first bar. What do we have on the second bar? Very, very narrow range. We don't even have volume here. We're just looking at range and close. What do we think is going to happen after bar B on number 2? Anyone venture an opinion? Yes.
There's no follow-through there.
All right. He says we don't have very much follow-through after the ease of movement in the previous bar. This man reads my mind. That's right. Absolutely. There's no more ease of movement. It's true, we closed on a very weak, in a very weak manner, closing on the low of the day. But if we had, since we closed so weak the day before and so much ease of downward movement, the lack of follow-through tells you there could be a rally on the next day. That seems more probable to me than just falling apart. Again, but no one knows. And about no one knows knowing brings up another matter. Opinions mean nothing. Opinions about the market. They mean nothing. You call me up on the phone and say, what do you think about the S&P today? You know, I can give you an opinion, but I should read my caveat, my disclaimer, because no one knows. There are times when I do have a very, very strong sense, an understanding of what's about to happen. And when we look at the S&P, the behavior on April the 26th in the S&P is classic. I knew as high as 90%, but anything can happen. All right, let's go to the next one. Any opinions? Now let someone else have a chance. I mean, he's got them all.
Any ideas? Just, come on, anything. Don't be frightened. You think it'll carry on going down?
Down?
Down? The general vote, this is going to keep going down?
I agree.
Yeah, well done.
No ability to rally. It just stays right on the low. In fact, we gapped lower, evidently. I don't show the opening, and I do think the opening is important. But we do gap down, and we stay down. All right, look at problem number 4. Everybody should know the answer to this.
What do we think? Up or down? Up.
Jim in the back, let me ask you a question about number 4. Do you think it's going up or down? That's right.
That's you, Craig. Yeah.
No, this other Jim in the plaid shirt. Anyway, he knows. Definitely. We have a nice outside bar, right? On day A, we have a relatively narrow range, and on day B, we go below the low and close above the high of the previous day. I would infer from that the market will try to go higher on the next day. It may end up having a tremendous downturn, but at least initially, I would think the direction would be up. All right, look at the next one, number 5. Anyone want to venture an opinion? All right. Tell me.
Because the bulls got smacked down in the dirt twice.
All right. He told us in a very colorful way that it's bearish and the bulls have been smacked down in the dirt. Well, he sounds like he's from the South. Getting smacked down. Anyway, you see the first bar, we close near the low. On the second bar, we actually rally above the high of the first bar. You see? And we don't hold it. And the market turns down, and we close on almost on the low of the second bar, and just about unchanged. Very poor performance. It reminds me of that chapter 7 that Gary Dayton was talking about yesterday at the top, when there was a bar there on that New York Times average of 50 stocks. The market turned down from the high on very wide spread, heavy volume. And the next day it did exactly the same thing as here. It went up almost to the high of the previous day and succumbed on the close to close nearer the low. Slightly higher, but very heavy volume again. Very, very bearish behavior. All right, what about the next one? On the next bar, it's a little more difficult. We have a wide open bar. We close well off the low on the first bar. The second bar is just a tiny little range. What does that tiny little range mean? Anyone want to venture an opinion? Low volume? Well, it probably could be very low volume. Most likely, I would think you're right. But it's also what Wyckoff referred to as a hinge. H-I-N-G-E, hinge. It's that point in the course of market movement where all of a sudden trading comes dead still to a point. We could assume that maybe to the left of these bars there've been some tightening up and now we've come to this point. It's very hard to know which way we're going to go, but just from this minimal evidence, I would say we would try to go up based on what we did on the first bar. All right, the next problem. We have a strong bar with a recovery off the low, and then we have a big gap down and close under the low of the previous day. How many people think this is a bearish setup? Right. It's pretty obvious. For the market to have closed that well on day A and then gapped all the way back down into day B and close under the low of A does not bode very well for day C. Okay? Conversely, we have almost the opposite here on the next one. How many think this is bullish? That's right. We have a bullish situation. The market closed on the low the day before, and here we gap higher, move above the high of the previous day, and close near the high of this day. What's your question, please?
Number 7, wouldn't that be a test on the number 7, the second bar?
Is number 7, is this a what?
Test.
A test? I don't think so. A test in this manner where you gap all the way back down to the previous day's low after recovering from that low, that doesn't look like a test. That looks like a continuation of the downtrend to me.
And David, this could be ultra high volume here on this bar.
It could be,
This
yeah.
could be a high volume bar
Mhm.
with lots of selling in it, closed off the high,
Right.
jumps back down.
But that's just an opinion. Remember, certainly, always have to view these bars in the context of the whole chart. All right. Now look at the next bar. I think it's the one there. Is that right?
Mm-hmm. That's the one we were talking
Oh, that's the one we just did.
about. Yeah.
All right, let's go to the next to last one.
Mm-hmm.
Number 9. Here we have 2 small bars. What's the story here? What's the trend?
Yeah.
You see anything that looks bullish in those 2 bars? Is there any ease of upward movement? Is there any closing well off the low of any of those bars? No. This is just something that slips sliding away. It's just moving lower. Going back to the problem before, this one, where the market gapped up. What's the range on this day? Is this a narrow range day? It's a wide range day. Who said that? Oh, of course. For the audience at home, the same individual who's answered so many others just raised his hand again. But I'm very pleased that you know it.
We found our next educator for the next best of Wyckoff.
I think we have.
It's actually that one and the one before for the same 2 reasons.
Right.
Average true range.
That's right. In other words, as this gentleman has stated so well, what we have to consider is the true range of the day. Not the actual trading range of the day, but the true range. On number 8, what is the true range on that day? Anyone want to venture an opinion? Anyone else? No one knows what the true range is on that day? Tell me.
Yeah, from the previous close to the recent close.
Right. From the previous close to the next day's high or low. In that case, low. That's the range. In fact, this is very important to be aware of the true range. Somebody would look at this bar and say, oh, well, this was a narrow range rally. Well, it wasn't a narrow range rally. They say, oh, there's no ease of upward movement. That's not true. The gap has to be considered part of it.
Repeat that. The true range is from the.
In the case of an uptrend where you have a gap open, the true range is from the close of the previous day to the low of the day when we gapped up, or rather to the high of that day, to the high. That's the true range. Sometimes on my charts I'll take the trend line and fill in the gap and use the bold higher weight, and just so it fits right in so you don't get confused about what kind of a day it was. All right, lastly, the last problem, what's going to be the outcome of this one? Franklin, do you know? Is it bullish or bearish? Bearish. He's right. And the reason is, on bar A, the market closes in the middle, and that would suggest that we might try to rally. But the rally on day B, we go up, we go above the high, and we come back and close just barely higher, closer to the low than the high, and the inference would be that the market is going to go lower. Okay? Let's go to the next chart.
Okay. Let me just see if there's any questions from the audience first.
All right.
I think there might be a question about the range, so let me just check.
All right.
Could you just ask the audience at home, is there any questions on those bars?
Yeah. If the audience at home, the question is, if you have something you want to ask about this bar-by-bar evaluation, feel free to do so.
Edmore Moses says, can you, the question is, how would you explain large gaps which are on low volume?
Lower, say that again.
How would you explain large gaps if they're on low volume?
Okay. Yeah, you heard the question. How do you explain lower gaps on low volume? To me, that just means there's no demand. The fact that the market gaps lower and closes lower, I assume, and the volume is not increasing, then the sellers are in charge and the buyers are unable to do anything about it. The market can go down on low volume. You know, people look at volume and they want to categorize it into set rules. That is, if the market goes up on high volume, that's bullish. If the market goes down on high volume, that's bearish. If it goes up on low volume, that's bearish. If it pulls back on low volume, that's bullish. These are guidelines, only guidelines. The world is not so black and white. It doesn't fit perfectly. There are times a market will go up because no one's anxious to sell short. The only selling you get is long liquidation and some obligatory selling, of course. But there are times when the market can go down on low volume because no one is willing to buy. Again, the only buying is short covering. Many times you get a high volume burst off of the bottom. It was called yesterday volume off the bottom. It was mentioned in one of the talks. And that's sort of like the prime mover in Thomas Aquinas' philosophy. What starts something happening, like a landslide, that first big boulder that gets things to move, the launch off the launching pad with all of that thrust power. That's that initial burst of volume that lifts a market up. After that, you rarely have that kind of continual volume all the way through an uptrend. The volume begins to trail off, and at times gets another boost of volume along the way. But you don't have steady, heavy volume throughout an uptrend. Just at key spots where it starts and lifts off, where it breaks out, where after it goes up and consolidates a bit, there may be another slug of volume. And then at the top, there may be some climactic volume. All right.
Another question here on problem 9.
Yes.
You've got quite a large gap down on this bar here.
Yes.
But if this bar here was on very low volume, what would that tell you? Is it still bearish if the volume was low on that bar?
I wouldn't be very excited about this, the way it looks, showing no ability to rally. It does gap lower and the market just stays just about on the low. Even if it's low volume, it wouldn't appeal to me just yet. If it was very high volume, that would interest me. Yes, question.
What I think makes it really bearish is that the high on the second bar couldn't even make it up to the low.
Right. In other words, a statement has been made here that what adds to the bearishness of this problem is that the bar B, the high is below the low of bar A, which I concur. All right?
Okay.
Let's go to the next page.
Could you just tell the audience on the web that all these slides are currently available for them to download from the customer area of the website?
Okay. I've just been told to let you know that all of these charts are available on the web from the customer website.
That's it. Thanks.
Did I do that right?
You're great. We should go into show business.
I think we should. Might be the Two Stooges. All right. We've got two charts here, each with 3 bars. My first question is, of these 3, which is the strongest situation, the most bullish situation? Take a look at them. On the first one, we have 2 bars and then a gap up. On the second one, we have a bar and then a very nice sharp rally, and then we go a little higher and so on. I have someone who's ready to tell me. Which one? Number 1 is the strongest.
Yes, because the first bar, you see it closing on the high. The next bar, you also see it closing on the high. It tried to go down, it couldn't go down, and instead rallies up on higher volume, higher close, and closing on the high. And then the third bar, yes, it's no demand, but with those 2 bullish bars in the background, I would expect it to continue higher.
Okay, the answer is that looking at problem number 1, that bar A closes on near the high, not the low, and most importantly, bar B is an outside day. In other words, we took out the low of bar A and we rallied and closed above the high of bar A on increased volume. And then on bar C, we gap higher with a narrow range and lower volume, but it's still because of the behavior on the 2 previous bars, he feels it's going to go higher. Does anyone disagree with that?
I agree.
All right, we have an agreement. Someone else agrees too.
But if you look at effort versus result on that, it was very little effort, and you got a really great result out of it.
On day 3?
On day 3.
Yeah, we're told here by an astute observer that bar 3 on problem number 1 is very strong because the market gaps away and holds its gain. I don't remember anything else, but that's about what you were saying. With very little effort. It took very little effort to break through the highs. Well, I agree. Of the 2, number 2 and number 3, which one is more bearish? Number 2 or number 3?
Well, okay, let me ask a question. Number 2 or number 3? Raise your hands if you think 2 is the most bearish here. Okay. And then if you think number 3 is the most bearish, raise your hands. One person.
No.
Okay, let me just ask. Can you ask the internet?
Yeah, on the internet, I'm asking again the same question. Which one is more bearish? Problem number 2 or chart setup number 2 and chart setup number 3? Of those, which one is more bearish? And the majority, yes, you have a question? Oh, okay.
Yeah, everybody says 2.
The majority of the room said number 2, and in this case, the majority is correct. And I think it's fairly obvious. You see that the bar 3 on number 2 is the highest volume of any of these problems. But forgetting about the other 2, just looking at this setup, you have so much more volume, and there's so little reward for the effort, and there's shortening of the upward thrust. Right? It's all there. So I would look at this chart, if I'm examining this at night or in the afternoon after the close, and I would say, just given these last 3 bars, the market appears to be in a position to try to go higher. Now I have to tie it in to the larger context. Okay, let's go to the next chart. If there are any questions on the internet, just fire away.
Everybody got that right as well.
Yeah, and that's pretty easy. All right, just a few charts here. This one is sort of tied to what we did yesterday. The question is, this is a daily chart. Do you believe this market is going to spring or not? Anybody venture an opinion? Looking at these bars, starting 5 bars to the left of the right-hand side, the low bar on the chart, you see that the market goes into new low ground.
5 bars to the left and to just
It's
there,
the big one, the big volume.
This one.
Yeah. We have an obvious horizontal line from the low on the left, right there. And on that 5th bar from the end on the right side, you see that price goes into a new low ground, volume soars, and the market closes closer to the low than the high. How many people would buy that? You would buy that? We have someone. May I ask why?
It's come out of an uptrend, when it went down, and come back and retest it.
So
what the gentleman's saying is it's coming. You mean coming out of a downtrend? You mean it's coming out of a downtrend? You said
coming out of the downtrend.
Yeah, let's be clear. It's in a downtrend, and it's hit the baseline here. The volume is very, very large on the down bar.
Right. Could be climactic. That's true.
Mm-hmm.
Yes. You have an opinion?
Isn't that bearish? Because you can have a spring where the horizontal line is.
Yeah. In other words, we broke that low.
Yeah, so in a high volume, so that should be bearish.
So someone asked the question, shouldn't this be bearish? We've had a high volume break of the low. I would say that on the...
We lost the sound for some reason. I don't know why. Just bear with me. I think the internet, it looks like the internet went out here. Okay, let me see if I can connect to the wireless. Rob, can you just type in that we're attempting to reconnect? They can't hear you, I don't think, can they? The internet went.
Everybody, why they're down with this, I was going to say, David showed charts about gaps, okay? You know what Wyckoff said about gaps? How you gaps? Gap is either the demand or strength bar, and we have it through range, but he never believed that they had it built. I just said gaps have to be built. They put this over.
Okay.
So people like, oh, I'll wait for the market to correct, just fill a gap. Markets don't have to fill gaps. On this note, it happens, it could happen by faith, but it has nothing to do with Wyckoff. The only way you do gaps is if they have a true range, if the market was a demand or supply market. Only the gaps have nothing to do with Wyckoff. Coincidence to do it.
I always say that gaps are the purview of dentistry.
You need to get the hotel and see if there's an internet issue.
Would you say that even if gaps fill, though, I mean, it could happen 2 months from now?
Okay, do you want to do a sound check?
When the gap and jam, they got filled
Okay.
this year,
Testing. 1, 2, 3.
I mean, primarily it's,
Do we have sound back?
if you're gonna wait for a gap, some people are dead by the time the gaps.
Yeah.
Gap in the, there's
All right.
gaps in the 40.
Okay, everyone, we're back. Good to go. So go on, David. Sorry about that.
All right.
All good to go.
Okay, we're back online.
Yeah.
Excuse the interruption.
You know, it's the composite operator trying to interrupt us.
Absolutely.
We're such a
He
good
doesn't
team
like,
here that...
he doesn't like this information getting out.
Exactly. There you go. You're right.
Okay.
All right.
All right, on this chart, as I said, the question is the market has gone underneath the low on increased volume. The spread is not too bad when you consider it did gap lower. But the main thing is we made a new low on heavy volume. One gentleman suggested that this could be the end of something and he would be interested in going long. And another person thought it was still bearish and weak because of the high volume and the position of the close. I can see how both could be right. The question is, this is a potential spring. I put the word potential in quotation marks and italics and underline. And you hear a lot of people who use Wyckoff, they use this word potential. And it's true, because we don't know. It could be. It has the possible earmarks of a spring because we didn't accelerate lower when we broke underneath the lows. We had all of that volume, and yet we just barely made a new low. But because of the position of the close being so close to the low, I think prudence dictates that one wait. And on the next day, once you see the market's tendency to go right back up, I think if you're watching the screen, you go long. And from that point, it's pretty simple. I can't see the volume on the last bar.
It's pretty low. It's a down bar. That would interest me, I have to say.
Yeah.
If I was trading that, what I'd be looking for is to take out that high, which it does. It closes above the climactic bar. And I would, if this then took out that high and we saw a test in that area, low volume, narrow range, testing those highs, that would be a buy for me without doubt.
Then where would you place a stop if you bought that spring?
The question is, where would you put a stop if you bought that spring? I would probably risk $1 or $1.25 underneath the low, something like that. It depends on the volatility. Obviously, if this is Google or Baidu, you're going to have to risk more money than that. But if this stock, it doesn't look like it's too terribly volatile or expensive. Okay, let's go to the next chart. All right, this is one of my favorites. Okay. Anyone want to venture an opinion on what the future direction is on this chart, given what you see here right now? What you see, what is the most dominant feature on this chart? What stands out more than anything else when you look at this chart? What bar?
Even I'm having trouble with that one, David, this morning.
For those on the internet, everybody's wondering out here.
Yeah.
Well,
Yao Ming,
yeah,
the basketball player.
Obviously, it's this large, wide-open, high-volume break that dominates the chart. All right. After that, you see that the market didn't make much further downward progress. And notice the closes on the next 3 days. On the next 3 days, the market tries to go lower on 2 out of 3 of those days, and the closes are all clustered together. That's telling us that on a net basis, on a closing basis, the market is not making much downward progress. Ergo, we know that somebody's buying. Right? All right. So the market goes up. Now, there is an important line, horizontal line on this chart that is going to tell the story. Does anybody have any idea where it is? Any idea? Yes.
I think it would be the lows, if you have a trading range above that, and it would be that first low. That'd be a lot more fun.
Here?
So I think he's looking at this one.
That one?
Yeah.
Right. Exactly right. The gentleman in the back has pointed out the line that's being drawn now on the chart. In other words, if I was framing this initial trading range, I would draw a horizontal line across the first high. And then I would make a line under the first low. And that's our trading range. You instantly see, of course, that we have an upthrust above the trading range. From that point, the market breaks down, and it comes back up to test, and then it falls apart. All right, now the market is rallying back up into that area. I always draw that line. When a market makes a high, and it has its first low, I draw a line under that low, because many times that low will provide general resistance on a rally. And you see it does here. We get a little bit above it, but on the last bar on the chart, you see the position of the close. It's well off the high. And notice how low the volume is on this day, the last day. That's telling you that demand is very weak. The position of the close tells you the same message. Nearer the low than the high of the bar, below the high and below the close of the previous bar. This is an excellent place to go short and put a stop just slightly above the high of the last bar. This is one of my favorite setups for going short. Okay?
Can I ask a question, if I
Yes.
can, David?
Question.
We've seen a climactic bar. Strength does appear on down bars, and the next bar is up. So on this bar here, on this very high volume, it could potentially be climactic. You're short there. Where's your target? Because for me, if I'm taking a short there, and I don't disagree with you, I think you could, because there's far too much supply. If Tom was here, he'd be saying, yep, there's too much supply there. They've got to come down and retest it. Would you expect them to come down to the close of this bar, so your profit target is around that range, or would you try and let it run past the close of the climactic bar?
My opinion would be that we would go below the lows that we have on that chart that were just made a few days earlier. In other words, this volume on the big wide open day is very heavy, and I would call it stopping volume. I'm not sure it's a selling climax, but I would say yes, indeed, we've hit a lot of sell stops caused by people placing their stops under that line. That's the bar where supply overcame demand. Those of you who've seen some of my reports, you see how I draw a little arrow over to that breakdown point on that bar, and I write S/D, supply overcomes demand, right there. And it's very typical to test that high volume vertical area on the chart. Yes?
Since you would expect it to go lower than what Gavin was saying, would you look for a one-to-one move, like AB equals CD?
And the question is, would I look for a move of the same size as the break? I don't think so. I would try not to have too many expectations of what we're going to get on the next wave. I would just be watching it as it unfolds.
Like that low over to the far left,
Yeah.
right around here.
Well, it certainly would be a logical place next, just given this history. But I would look at the weekly and the monthly as well as the daily. I wouldn't just be focused on, I would be studying this chart, but I also want to be aware of where are we on the weekly and monthly.
Can I? John's got a question, and I'll take it. John,
Yeah.
long-standing. Yeah, John.
This looks very similar to the daily ES or the Dow Jones average last week.
Yeah,
Big break, now
Yeah.
going up or retesting,
right.
backing up to the creek, so to speak.
Yeah.
So it could come way off.
There's just,
All right. So the statement is that this resembles this gentleman of what we have in the S&P right now, and I agree completely. There's a few differences about how far we've come back and so forth, but it's exactly the same concept, that the market has rallied back to previous support that's now serving as resistance, and back to the area where the high volume selling broke through demand, broke through the buying.
can I ask a question, David? Just two things here that confuse some people. We talk about strength appearing on high volume down bars. Now here is potential weakness. Now there is a big difference between this bar and the Dow Jones bar. Can anybody tell me what the big difference is? The last Thursday's Dow. Correct. Now that to me would tell me something. The close on that bar closes on the low, and it takes out all the previous areas here of support. That is very bearish, and when you test it here, you'd expect the test to fail. Now, tests are shown as signs of strength, and they're green indicators in the Trade Guider program. But a failed test is an even stronger sign of weakness. So if you fail a test there, you've got to be short because of that. However, by the fact that the Dow closed in the middle on high volume, remember, on high volume anywhere, there's always going to be supply still in the market. And if you listen to what Tom said this morning, he said, look, you're going to see weakness at exactly the same level David saw it. What did he see in Tom's presentation? An upthrust. He didn't know it was there. He said there's an upthrust, or he saw the upthrust and he didn't know the next bar on the Friday would be a down bar. So what you can infer is exactly that. We should expect to come down to the close of the Dow Jones bar, or even the bottom of that bar. And if you want to know what the future of the market is, when we take out the bottom of that bar, you could infer we're going into a little bit of a bear run. Does that make sense? Do you agree with that?
It makes sense, yes.
Good. Okay.
Okay, let's go to the next one.
So Gary wants to...
Just make a comment. If you go back to David's very first chart from yesterday, his presentation,
Thank you.
you will see this setup right there. That where you find trades. This is breaking down through the trading range and coming back up to testing.
The observation has been made.
Yeah.
that looking back at my first chart, that diagram of where to find trades, I pointed out testing of breakdowns. In other words, we have a trading range. In this case, it's already drawn on the chart. The market has broken through the bottom of the trading range. There was no spring. And now the market is running back up to test that breakdown. And what you ideally want to see is about what we had in the S&P, particularly narrow ranges and low volume. If you remember the S&P chart, and I'll show it to you again today when we get a little further along. Okay, very good observation. Thank you very much.
Well done, everyone. Right, let's just have a quick look. See if there's any questions from Janet, yeah, one of our customers, Janet, said she didn't consider this bar to be the same as the S&P bar, and it wasn't. The S&P bar closed in the middle, this closed on the low. That's fair. That's why, but the principle there is now we know what to look out for over the coming days and weeks. If we see what we expect to see, Tom was expecting to see weakness at these areas here. If this was indeed the S&P and closed there, as we go back up to those levels, if it goes up on no demand, up thrusts, an increase in volume on up bars, that's potentially weakness. And if it then comes back and tests that level, we don't know what the market will do. We can't say for sure, but we certainly now know the chart patterns to look out for.
Right. Okay.
Next one.
All right. Now we have another situation. Again, we have a bar in the middle of the chart that dominates the whole chart, right? The market had been going up, and suddenly we get this huge break. I don't know what this is. I don't remember.
Doesn't say.
It looks like the Nikkei or something. Is that 13?
Yeah, 12,800. It could be the Dow, actually.
Maybe
no,
so. It might be the Dow.
Yeah.
Anyway, raise it up just a little bit, please.
There you go.
All right. So you see the market gets hit very hard. It finds a little support, and then it rallies slightly. And after that, it gets another harsh slam down to a new low. I draw immediately the horizontal line across the first low. You see that we've gone under that line, and look at the position of the close. The position of the close is higher than the previous day's close. It's near the high of this day's range, and the volume is the second heaviest on the chart, and it's the heaviest since the top on this chart. That looks like a spring. Now, we're going to wait for a secondary test? Please do. But the train just left the station. You see?
That bar there would be very interesting.
There is a little pullback a few bars later.
Look at the volume. That's really low. That's great.
And it was much lower volume, but it doesn't give you much of an edge in terms of the risk. All right. From there, the market works its way higher. Draw a line across this high. There's the top of the trading range. There's our range. We've had a spring. The market has broken out. Now think about my diagram, where to find trades. When a market is in a trading range like this, it has a wide open range that breaks out, a big wide range like that one, and then it pulls back to test. This is a potential test of a breakout. This is not enough thrust, but a potential test of a breakout. Look how the volume has contracted. Look at the position of the closes on the next to last bar in that outside range on the next to last bar. That pretty well solidifies the story on the next to last bar. We have a big reversal, right? Mm-hmm. And we close well off the low. That tells you that there is no selling pressure here. It's a little minor spring. We went under the low of the previous 2 days, right in here. And we're starting to turn up. And in this case, the market is going to go higher. Any questions about this chart? So although we have a huge wide open break in the middle of this chart, just as we did on the one previous, we still have to look at the behavior. We can't just dismiss it because, oh, it's just like the one before. I don't want to touch this at all. It was indeed until you had the spring. Then the situation began to change. All right, let's go to the next one. All right, this is one of my favorite charts. This is the cable yen. This is a monthly chart of the cable yen. The cable is the British pound. I was consulting with some traders in Malaysia during this time frame, and we were watching this rally. As I told you yesterday, on Forex charts, particularly on a monthly chart, I can't use tick volume on a monthly chart, so I just use the true range as a proxy for volume. And you can see I've drawn a red arrow underneath the wide price bars since we broke from the high. And they correspond nicely with the four big wide red range bars down below. We had great ease of downward movement on those bars. Also notice that the breakdown was preceded by an upthrust above the top of my trading range. You see? I draw the trading range. Where do we find trades? There was one right there. Notice the size of the ranges there. And then the market breaks wide open, and it has a 2-month rally to test that upthrust. And then it breaks wide open again, coming back down. It hesitates for a month, and then it falls apart again. Finally, we find some support, and we have 4 months of relatively narrow ranges, higher highs and higher lows. As we creep upward, we're testing that big wide open bar where supply overcame demand as we broke through the trading range. I mean, I know supply overcame demand because you see what it did on the chart. I don't even have volume, but I know that. And I can tell by the size of the range that there must have been huge volume. So this is a test of the breakdown. It just doesn't go all the way back up to the line like we saw on the chart, two charts earlier. Notice the green range bars declining in size, just like volume would be declining on the up wave. I told someone in Malaysia we're going to go considerably lower. If those of you know, the cable yen went to 120 or 125 from this high on the chart. So we had a 50% collapse from the all-time, the high on the whole chart. Any questions about that chart? But it's very useful to use range on Forex charts. And now I'll show you one on a 5-minute chart along with something else. Okay. This is the cable yen on a 5-minute basis. This is for the person who's trading intraday, the Forex market. I have price. I have the range bars underneath the price. They're red and green. And on top of the range bars, I have a little line that represents tick volume. Instead of making the tick volume into a histogram, I made it into a line chart. And so it's resting on top of the range bars. And then below that, I have something called the net difference between the up volume and the down volume. In this case, the difference between the up tick volume and the down tick volume. And so when it's down, it's colored red. And when it's green, of course, it's colored, it's up volume. And you can see coming off the high, we have an up thrust on the high. We need to go up a little bit, just a little. Just up a little, yeah. You see we have an up thrust. Look at the range when it goes into a new high ground. Look how narrow it is. When you see a market go above a previous high and the range narrows, like we saw on April 26th on the S&P, be very aware and wary that the market is in trouble, that it's running out of demand. And from there we come off, and when we break, we have this huge range bar. There must have been a lot of volume. The tick volume is starting to move up. The little line is starting to move up. It's probably the heaviest at that point. And notice the net down volume on that bar. This is not a mathematical formula. This is just market-generated information. I use TradeStation. When I click on a bar to look at in the data window, They give me open, high, low, and close, and they also give me up volume, down volume. So this is the difference between the two figures. That's all it is. And in addition, on the bar chart, you see a little blue line. That's a cumulative line of the tick difference. In other words, it's adding up the tick volumes up and down as it progresses during the day. And so I like to have the trend of the net up or down volume on top of the chart. So I have volume and price moving together here. I'm not looking for divergences or anything like that. This is another aid for reading the tape. That's all it is. I'm sure if Wyckoff were alive, he'd find it very interesting. The net difference is not always going to be informative, but then again, what is? Volume is not always informative. The most constant information on the chart is the bar and the position of the close. And even then, too, you have some ambiguity. Anyway, this chart turns down. You see my channel. You see how the market stays within the initial channel very nicely. We come down to the low of the chart. You see how the tick volume is beginning to increase again. And we're having a big range and very large net down volume. We're at the bottom of the channel. It's pretty much of a crescendo. We know that the market's poised to go up. And then where I have this little green arrow on the chart, that bar has the most net up volume of any bar on the chart. Suddenly, we have not up volume, range, excuse me. The range on that up bar, in other words, the up range, is larger than on any other bar of the chart where it went up. There's no up bar bigger than that one. That's a subtle change in behavior, but I look for those. I'm trying to get the edge. I'm always comparing. Is this the heaviest volume in 20 days? Is this the widest range in 20 days or whatever? All right. So any questions about this? I mean, this is...
Can you get up volume and down volume in the signal as well?
Yeah. You just get the ticks.
Right.
That's all you have in the forex market, no matter where you go.
What did he say?
I was asking if you can get the up volume and down volume in these signal as well.
Is it ticks or volume?
Well, it's the movement of the bid, really. It's indicative volume, right? That's all anybody has.
Well, this is actual volume.
You can get it.
This is actual volume.
That's actual dollars traded.
Dollars traded. Right.
Really?
Yes. If you add up the two figures up and down, you get the total volume for the bar.
But what is that volume? Is that the movement of the bid, or is that actual dollars traded? That's my question.
I think it's actual dollars traded, up and down. But I'm not 100% certain of that.
Well, Tom Williams will tell you that there is a way, it's a proprietary way. There's a product that we can't release to you. And there's a reason we can't, because we can't support it, because it's a very old product, but it does collect tick data correctly for the forex market. Now, the thing about the signal volume that we get is it's giving you a consensus of opinion. And what's so valuable about that, if you consider it, remember Tom told you you don't need actual volume, but relative volume. If we look at the consensus of opinion on the eSignal platform, the way and I know TradeStation doesn't do this, but with eSignal, what happens is it gives you the range of the bar and it gives you the tick movement. Now, I want you to get past the volume for a second and remember this. Volume is activity. And eSignal, the way they chart it, is unique. I can't find anyone else who's done it, which is why I'm using eSignal. Now, what happens is they chart it in such a way that you can use relative volume to the previous bars. Now, if you're a forex trader, a very quick one while we're looking at this chart. I like to trade I'm not a 5-minute forex trader, a 15-minute, an hourly, a 2-hourly, and then a 4-hour chart. The 4-hour, the 240-minute is the greatest chart. I agreed with Paul. There's a reason that the 240-minute chart has precedence for me over everything else. Can anybody tell me why?
It breaks the day down. I told him the answer.
Well, you're the educator. Why? What, how many hours is 240 minutes? How many hours? How many hours in a day? Right, 24 hours in a day divided by 4 gives you 6 segments. And then you look at the major how many sessions are there, the main sessions that are traded in Forex? Does this all start to make sense to you? Of course. The 240-minute chart is the easiest one to see when you chart a 4-hour chart and you've got 3 major segments and you've got the Asian, the European and the American session. Guess what? You start to see accumulation and distribution. And each signal, if you just use the 240-minute GTIS feed, which Craig can tell you more about at lunch, if you just use that, and you know, Mike Panici at the back there, they also have their own volume at PFG, which if you align it, which you'll have to show them, Mike, at some point, when you align the PFG volume, and I know Gail is with us, by the way. Gail, do you want to just stand up and introduce you quickly? This is Gail Mercer, everybody, be speaking later. So Gail will be talking, but when you align that, and you use the PFG volume with the signal bigger volume picture, you get nuances in your platform that you've actually said, Mike, we were discussing it at lunch, signals are superb in VSA. And then if you combine it on the bigger platform, so look at the 240-minute first, then go down to a 60-minute, then go down to a 15-minute. You don't really need much more than that. Now, I do use a 5-minute chart occasionally after a news announcement, because then you're going to start to see everything's going to happen quickly and you'll get a decent entry on the 5. Sorry, David, I thought I'd add that because it's quite important. So there is a unique thing that these signals do have, is that volume. And you must check it out. Please go and check it out. Speak to Craig and he'll tell you how they do it, because I don't know. I know it's bank feeds and it's, you know, at some point, Craig, I'm sure they can come and ask you. Right.
Well, I use this more on futures charts and on stock charts than I do on Forex, because I don't trade Forex. But I have some clients who trade Forex, so I feed them some ideas occasionally using this. But I find that it's much better when I use it on futures and stocks, because the net difference numbers will be huge. Nothing like these small numbers here based on tick volume. But it's still the same principle. It works. And sometimes it gives you great clues. Now let's look at the next chart. This time I have it on a daily chart. Well, no, not on this one. This is a
ES07.
Yeah, this is a chart of the S&P E-mini, and here we have the net up and net down volume. And where would I draw a horizontal line on this chart? Can anyone tell me? No one tells me.
Come on, anyone?
Tell me. Tell me.
Those lows going across.
Yeah. Right in here.
Yep.
Right there. Yeah, good enough.
Almost like what you're talking about.
Right. That's the line.
But I would want to see some touches on the opposite side of that line.
All right. So you see the market has a big wide open break with high volume as it goes under that line. Look at the net difference on that line. The net difference is very large. In other words, there's lots of selling. The way I like to use this is I don't really pay much attention to every little bar reading on the net difference. I'm interested on the big readings. Those are the ones that stand out to me, particularly in conjunction with the volume. And so I have big volume. I have over 30,000 contracts traded, and I have very large net down volume. So I know that there's a ton of selling coming in, and probably a lot of it is people throwing in the towel on the breakdown under that support during the day. The next bar does very little, and then the market goes lower with even, it moves slightly lower with heavy volume again on the next to last bar.
Yep.
Has heavy volume again and very large net down volume. What makes that bullish? Does anybody know what makes that bullish? We talked about it. It was mentioned yesterday. Effort and what?
It didn't make much progress.
Very good. Someone has volunteered a correct answer. It didn't make much progress. In other words, the result for the effort was minimal. That should alert you immediately that all of this volume and all of this net down volume Someone is in there buying in the face of that, because we made very little downward progress. And on the last bar, the market bobs up and gets away from the danger point, and that's where you buy it. And you put a stop under the lows. Yes?
I have a question. On a low volume bar, how do you differentiate between no demand and no supply? How do you know which one it is?
All right, the question is, how do I differentiate looking at volume, no demand or no supply? Okay, well, usually when you have demand, you also have some ease of movement, upward, and if the volume increases, that adds to the picture as long as it's not too large. Conversely, no supply would be going down without great ease of movement, perhaps, and low volume, relative low volume, would tell you that the selling pressure is easy. But, you know, it's very hard to put these terms to make them into absolutes. That's what makes reading bars on a bar-by-bar basis so difficult, and so difficult to program, to interpret every bar. I thought years ago of conceptualizing in my own feeble way some kind of software to read the chart on a daily basis. I would evaluate each bar. Does it close unchanged? Does it close on the high? Does it close below the low? Does it close above the previous day's high or the previous day's low? All of these different factors, and give them a rating, give them a number that would help you evaluate it bar by bar. I think what VSA has come up with is much, much better than what I was playing around with.
I'll show that later, but just, so let's go back to your charts. Can I just cover that point just quickly? Very, in simple terms, I'll show this tonight, so ask the question again. No supply for a good, perfect example, and you do get them, is a down bar. So it's on a down bar. The spread or the range should usually be narrow. The volume should be low to ultra or very low. The lower, the better. If the range of the bar is narrow, great. On the opposite side, no demand is on an up bar. It's a bar that closes higher than the bar behind it. The spread or range should be narrow, and the volume should be less than the previous two bars.
Is that some specificity for you?
Let's be specific.
I lack specificity. Yes.
Hold on a minute. Hold on a second. Before we go, we've just lost the internet again.
You lost your speech.
So, yeah.
Speech is probably this.
What?
No, we've lost the internet.
Cut off another speech.
Okay, start. Connect.
1 minute.
Just let them know. Give you Rob that we're connected.
Why is reconnected? Do you have any questions? I mean, no, yeah.
There was some questions there.
Okay, we're back on. It's the smart money playing games. You're back on. Okay.
All right.
Just to say it's the
Okay.
composite operator trying to shut us up.
The question again, please.
You drew a top trading range, and you drew a short line.
Right.
You draw it under the low of.
I would have drawn the line here.
Okay, on that low.
Yeah. That's how I would have drawn it.
Not the previous.
That's right. Not here, but here. Because the high was up here. You see? I think of it like a ball. I think of it like a ball. In other words, a ball goes into the air and gravity stops it. That's where I draw a line of resistance. And when the ball hits the ground, it's found support, I draw the support line. And then I watch as it unfolds. And you see that in that trading range, you had an attempt to spring. The market went underneath the trading range and tried to spring. But unfortunately, it couldn't go. There wasn't enough volume to lift it off. Look at the tiny volume in there after that low on the rally.
Can I make a suggestion? It's now 11:15. Can I suggest we break, because everyone's got so much to absorb, and I know that after this amount of time you start to flake. So could we break for 15 minutes?
Yeah, we're going to take a break.
Till 11 o'clock, and then we'll finish this and go to our next presentation. Thank you.